Good evening. Good evening. I think a lot of people got here early, which is awesome. So I'm going to put you guys up in the chat first. Good evening. It's 7 o'clock. We'll be here till 8 o'clock. I'm Shahida Hill, getting you over the hill to home ownership and helping you confidently buy your first home. So tonight is going to be about the update in age, the increase in age for first-time home buyers. We're going to talk about that, and then I'm going to answer your questions. So I just wanted to start off with mortgage rates. Mortgage rates today, the FHA rate is 6.3 on average. This is from Mortgage News Daily. And the conventional rate is at 7.02. So pretty much where it was like election day or right before the election. They're pretty much in the same spot. They did have a CPI number come out. That's Consumer Price Index, basically how much has inflation increased from October of 2023 to October 2024. And that was about 2.6%, which is a little bit higher than last month, which was 2.4%. So people are thinking, and the Federal Reserve chair said today that they may not have to decrease interest rates, or he made a comment similar to that. So a lot of things go into that, decrease in mortgage rates, and inflation is a big deal. The deficit, what Trump is going to do or is proposing to do with the economy. So right now, most people are saying that rates are either going to stay kind of where they are. They might, go up a little bit. They might go down a little bit. But I would think, if you're plan for them to be in the sixes. And then if the economy or something, if everything goes better than expected, then it might go to the fives. But a lot of people are still getting 5 or 5% rates, either, or maybe even lower. Either they're buying new construction and the incentive is allowing them to buy down that rate, or they are using the seller's closing costs, or the seller's closing cost contribution to help them buy down their rate. So either one. So people are getting lower interest rates than this through buying down the rate for the most part. And I would say the reason why you want to make sure you're quoting both conventional and FHA is that FHA is significantly lower than conventional. So even with you having to possibly, with FHA loans, pay mortgage insurance for the most part for the life of the loan, the lower interest rate may make up for that mortgage insurance. So even though you're thinking I'll do conventional or I'll do FHA, you probably want to quote both and see which one makes the most sense for you. All right, so we have some people that got here early. And we're going to talk about age. Like I said, I'm going to be 38 this year, and 38 is the age. You probably saw it on the thumbnail when you clicked on this video. 38 is the new age. That is like the average age for first-time home buyers in 2024. In 2023, it was 35. So we're going to talk about why I think that's kind of a big deal. But of course, buy it as soon as you're ready, right? Financially to buy it. But the earlier, the better for the most part. And we're going to talk about that. So she is a nurse. So she's, I'm sure, financially stable. That's a good career to be in. Debbie Smith says, I'm going to be a first-time home buyer soon, as she's in the inspection phase. I'm 62, and I just know that God's going to make a way for me. I'm a big proponent of buying a house in retirement. And the reason why is because you're going to stabilize your expenses for the most part. It allows you to stabilize. You're on a fixed income, most retirees. So you can't, if your rent goes up every year, but your income doesn't really go up that much, you may be in a tight spot. So you want to be able as much as possible to fix your income. Now, you could do that with some rental properties that are rent controlled for seniors. That might be an option for you. But there's also, I would definitely tell you to move to a state or a city or a county that doesn't, tax. A lot of people, they exclude or reduce significantly senior taxes. They have senior tax exemptions. A big part of that is a school tax. They don't make a lot of seniors pay, particularly in Georgia, depending on where you live. I'm in Georgia, so I'm aware of this, but other states do the same thing. So I like for seniors to move to a place where they're not going to be taxed property taxes or not as much, and they'll be able to save a lot with that. So hopefully, Debbie Smith, you're moving to that area or that type of area, and you're aware of the exemptions. All right, so thank you for joining me. Like I said, we're going to answer as many questions as possible. I want to go over a couple of things before I take questions, though. I think my moderator is doing is going to choose the questions for me. So my next thing, kind of the topic of this, the average age of first-time home buyers is 38. That's up from 35 in 2023. And so the reason why I think this is a concern, that this age keeps on going up, is because, and we kind of know why it's going up. One of the major things is that the cost of housing right now is more expensive. The house is more expensive. The interest rate is more expensive. And generally, as you age, your income increases. So more people are able to afford a house because they're older and they're more established in their careers. But if we talk about, say that you live with your parents, you go to college, maybe you get your first apartment, and say at 25, you are working, you have stable employment, you're able to buy something, you're probably going to be missing out of 13 years, right? Because, you know, 13 years between 25 and 38, right? There's 13 years that you're not building any kind of equity. All of that rent money, let's assume that rent is $1,500 a month, and you're going to do that for 13 years. Over that 13 years, you spent $234,000. And we know a lot of, 20 somethings that are probably paying more than this. So I want you to at least younger. So if I have any younger people on here, that you are at least looking into home ownership. Now, if home ownership is so much more expensive in some, like say New York City, it might be that the apartment is $1,500, but the house is $3,000 or $5,000. Then that probably doesn't make sense. But you should be making more in those cities. So usually if you're making more in those cities, then go ahead and get the cheapest rent possible and start investing that difference, not in a house perhaps, but in the stock market, in your Roth IRA, and your 401k. That's what you'll be doing with that gap between what you're making and what your rent price is, right? So you have to, take advantage of that. And I want to say too, another study came out today, that the average household income that you need to buy a house in most states is around 107,700, so about 108,000. So if you're in a two-person household, that's pretty reasonable. Everybody's making at least 50,000 or so. But if you are single, then that probably is more of a challenge, unless you're you're making six figures by yourself to buy a home, and that's including taxes and insurance. In 2019, that amount used to be $56,800. So it is and we're talking about, I did my video about the election. I think the election was more about, for a lot of people, how they were, or how they felt prices were in 2019 and what they felt prices were in 2024. Even though a lot of people are making much more money, because, with inflation, salaries had to increase, not significantly, but salaries had to increase with that inflation for you to afford anything. And I don't want people to get the false impression that prices are going to go down significantly. Like, we're not going back to that 2019 pricing. So, and my last thing, what I said in my video, if you haven't watched it yet, it's my last video that I released. You need to be budgeting. And that's what you need to do on the daily, but definitely budgeting. I say you should start a business. Even if you don't feel like you're business minded, you want some kind of income that you control and not just being controlled by your employer. And you need to start investing, even if you cannot buy a house right now. Okay. So these are three things you should be doing. So let's go to the questions. I'll take the first question. I think it was from Alexis. All right. Alexis says, good evening. Typically, how long are pre-approvals good for before having to redo your application? I have one lender that is telling me I have to redo my application since it's been 6 months. So it's going to vary by lender how long that pre-approval is good for. For some people, I think at the minimum, they're usually 90 days, probably at the maximum is 6 months. But you can make that decision whether you want to reapply based on where you are with the home search. So are you going to be going back out to look at homes? You probably do want an updated pre-approval, because if you put in an offer, you don't want to put in an offer with a old pre-approval. But you're not doing the entire application again. Typically, when I would call it an update, they're going to update your application. They are going to make sure that you're still employed. So they'll probably ask for your last few check stubs, and then they'll run your credit again. So you don't have to, if you did a whole application online, you don't necessarily have to do that over, but they will ask you to update that application. So if you are, I'm sure you haven't been looking hopefully you haven't been looking for a house for 6 months, but if you are, if you've taken a break or that sort of thing, you don't have to update it. But when you're getting back out to look seriously and you're thinking about putting in offers, you want to make sure that you have an active and updated pre-approval. Thank you, Alexis, for that question. All right. Does that mean seniors over 60 plus? So I'm talking about retirees, and the age that the senior exemption is good for, Kamari, it varies by where you live. So sometimes they'll give you a senior exemption at 62. Sometimes they'll give it to you at 65. So if you are a senior approaching those ages, I want you to really do your research to find out what that is ahead of time, because it might be a big difference between where you plan to buy your property and how much you're going to have to pay in property taxes, because everything is not the same. So I'm give you an example of Atlanta. There's Fulton County and Cobb County. So if you were to move, and they're bordering counties, if you're moving to Fulton County, the age is much higher to get, or older to get the senior exemption, where if you move to Cobb, it's much lower, or some years lower. So that should play a part in your budgeting as to where you're going to live in your senior years. It's really important for you to know that ahead of time. Thank you for that question. All right, we're getting to it. All right, Candy. For savings on property taxes, I believe your income must fit the criteria. I'm 62, and it appears that the application says you must not make over a certain amount. That is true in some areas. So some areas, they don't have any, like what I said, you have to research ahead of time. So if you have an area, a city that you're thinking about moving to Houston, and then Houston has, or, Houston suburbs have different counties, and different tax commissioners, that sort of thing. You want to look at each county and see what their homestead exemption rules are, because some of them, and I'm gonna talk for Georgia specifically, there's no income, it's just age. And also it's only one person, at least let me talk about where I live. Where I live is 62, no income requirement. You don't have to worry about that. It's automatically done at 62. You can be making whatever. And only one person on the deed has to be 62. So say, for example, you and maybe your child, your daughter, who's like in her 40s, is on the mortgage with you. The home would qualify for the exemption. You wouldn't have to pay the school tax, which is probably like 70% of the taxes, because at least one person on the deed is 62. So you want to do that research ahead of time, because that's a big deal. I thought about moving my dad in. I was like, come on the deed. I'll quick claim this over to you, or add you to my deed, and we can get rid of some of these taxes, because it'd probably be, for me, it'd probably be a savings of like $300 a month. All right. Thank you for that question. Rose. Hey, Rose. I enjoy the information. It's very helpful. I appreciate it. Is it wise to use a retirement funding account to put down for real estate? Typically, no, because you don't want to have to pull funds from your retirement account to fund your real estate, because there's usually penalties that come with that. Like your Roth, if you have a Roth, I believe you can pull any contributions, not any gains, without penalty. But again, do your research before you start pulling from those accounts. Ideally, you want, for compound interest, you want to leave the money in your retirement accounts and have that grow and not have to touch it. So anytime you're doing something financially, think about the loss, or the financial loss, if you're doing it in that way. So if you were to say, I'm going to take $20,000 out of my 401k to put it on a down payment on a house, and some, ask your plan administrator. Sometimes they have, special rules. If you're using the money to buy a house, you want to say, okay, do I pay a penalty, a tax penalty? What does that look like? How much I'm going to spend, versus maybe using down payment assistance, maybe saving on your own. I would say in general, it's not something that, people would advise. However, like over the pandemic, they have relaxed a lot of those rules and allowed people to, pull from their retirement accounts tax-free, or without penalty, right? So a lot of people were doing it around that time, and it probably made sense for them, looking back, to say they got their house probably for cheaper, lower interest rates than trying to buy them now. But you really want to, weigh the financial cost of that. It could, say that it's you find out you're going to lose maybe $3,000. Is that worth it for you? Or is something like, oh, I'll wait for that. So just, what you're getting into. And usually you can look, wherever your plan is, wherever your retirement account is, you'll be able to either meet with somebody, email them, to find out all those rules. Thank you, Rose. All right. What would be a good, sorry, let me get your name. Amp for Miami. What would be a good amount of money to save before attempting to purchase a home, not including closing? Okay, so generally I say 7% of the house price. And how I'm pulling that 7% is that, and I'm pulling it for down payment and for closing. So if you're closing, and let me say this, I'm still going to say 7%. The reason I'm going to say 7% is because who's not paying closing costs, right? It's a good thing if you could find a seller that's going to contribute to your closing costs, but that's not always the case. So you don't want to plan on that happening because it may not happen, right? So I really advise people to save that 7%. And I'm thinking in my mind, they're either doing a conventional 3% down or they're doing an FHA 3.5% down. And then closing costs are probably another 3.5%. That's where I'm getting that 7 from. And that should be enough. So $100,000 house, $7,000, $200,000 house, $14,000. So you get the drift. But if you are thinking that the closing is going to be taken care of and all you have to do is worry about the down payment, I would save, I'm going to round it to 4%. Save at least 4% if you know that for sure your closing costs are going to be covered. All right. Buff, I'm going to say soldieress. Okay. Thank you for your question. When you pass the 6-month pre-approval, what if your income hasn't changed, but your credit score decreased? Will that affect your numbers? Possibly, right? Because I'm gonna say this, it would have to probably decrease significantly because when they approve you, they're pre-approving you generally on a range. So if you started with your pre-approval process and your mid score, because they're always looking at your middle score. So you have 3 credit scores. They're going to exclude the highest credit score. They're going to exclude the lowest credit score. And generally, they're pre-approving you on that middle score. So say that middle score at time of pre-approval was 665. And then when they pull your credit again, say that middle score is 660, I wouldn't anticipate anything changing. But if it's like they pre-approved you at 700, like your credit score was 700, then you maybe paid some bills late, did something wrong, and then your pre-approval or your credit now is 630, that could impact either your interest rate or what you're qualified for. It really depends because sometimes the higher your credit score, the more lenient they can be with debt to income ratios. So it may, impact your ability to qualify, and it could impact also how much you qualify for. But good question. So and I'll say this as a tip for everybody, make sure when you are pre-approved that your financials don't change. They could change for the better, but don't let them change for the worse, right? So don't make any, large purchases, don't change your job. Everything that you got approved for is what you need to try to maintain at least up until after closing, right? So if you want to change your job, change it after closing. If you want to go buy a car, do it after closing. Don't do it, before closing, because this is a simple mistake that people make. I had one of my clients, he was a W-2 employee, and then he found a job that was going to pay him more money, but he was going to be a contract employee, and he quit his W-2 job, took the contract job, and he was no longer pre-approved because he had to work, a contract job or 1099. They consider that like self-employment for the most part. So in order to, get pre-approved, you have to work that new job, even though it's paying more. You have to work that new job for 2 years in order to get pre-approved. So totally went from being approved to not being approved just with that job change. And he really thought he was doing a good thing because he was making more money. All right, good question. And thank you guys for joining me. My moderator is picking the question to make sure that you're really cool, clear about a question versus just making a comment, because I know you guys are talking in the chat. If you will do me a favor and hit the like button, I appreciate it. We're at 245 people. I appreciate that. I'm going to get through as many questions as possible. And also I have my master class, of course. So if you haven't got my master class already, please go ahead and get it. I really appreciate your support, and it will help you greatly make good decisions with the home buying process. All right. So Celine, question. Can you have someone on the deed but not on the mortgage? This is an absolute yes, 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 yes. Okay. So when you buy a home, typically the person that applies for the mortgage is the person that is going to be on the deed. However, you can add somebody to your deed pretty much at any time, and it's pretty easy to add somebody to your deed. You don't even have to get their permission. They don't have to sign. Most states, they don't have to sign anything. Like when I was talking about adding my dad to my deed, I could just add him to my deed and I sign it, but he doesn't really have to sign anything. And most states are like that. I'm adding that person to my deed. They don't have to necessarily agree to be on my deed. I could just add them. Now, what happens with that now is I'm married. So I'm on my deed. My husband's on my deed. Now my dad's on my deed. So say we're ready to sell the house or refinance the house. My dad now has to give permission because we're three owners of this property now. So he has to give permission or authorization or approval for us to sell, refinance, or do anything financial with that house because he's an owner. Like we're all owners of this property. So you have to be really, really cautious about putting somebody on your deed because you're giving them ownership and control. And this usually is a big deal or something that winds up not being fun when people like go in as couples or add their boyfriend, that sort of thing, boyfriend, girlfriend to their deed. They break up and they're like, okay, well, I'll take my name off the deed if you give me this amount of money, that sort of thing. Now, I say it's different than if you're married because you're going through the whole divorce process. There's more like paper, there's everything that's going to be probably litigated as to what you'll get and what you won't get versus a boyfriend, girlfriend. You're going to have to work that out. And if they say they don't want to, they don't want to sell, they want to stay or something like that, then you have to take them to court. All right. Good question. But the answer is yes. Tanji, how are you? Okay. I have a good friend who bought her home 2 years ago. She has experienced a $700 increase in her mortgage due to property taxes rising in Georgia. After complaining to the tax assessor, they brought it. Okay. I don't know. Did they buy her whole house? I don't think there's really a question in here, but hopefully she did not. Okay, this is what could happen, right? So, did the tax assessor buy her house? I doubt that happened. Or did they buy her taxes? So, when you see all these commercials and advertising for like buying a house for $100, or in this case, maybe buying a house for whatever, I don't know. Say there's something called a tax lien. So if governments still have to run. So if you stop paying your taxes, they still have to get tax revenue to make their, pay the fire people and the police and all that kind of stuff. So what they do is sell tax liens. They'll allow anybody to pay the taxes for those homeowners, and then the homeowners in most states have to pay it back with penalty, or after a certain amount of time that person could foreclose on their house and get that house. So I'm not sure if you're saying that the tax person bought their house or if the tax person just bought the tax lien or whatever they, didn't do. I wouldn't have sold my house. Or if this was a problem for me, I probably just would have put my house on the market rather than selling it to the tax assessor. So I don't think it's a question. Maybe you're just saying, what happened to your friend, but that seems pretty unusual that the tax assessor would buy it. Good question. All right. Make sure you're putting your question in the chat so we know that, so the moderator knows if it's a question or if it's a, what am I trying to say? If it's a question or if you're just making a comment. All right, Yvette, I need a comparison with townhouse and a condo, Yvette in Florida. Okay. So number one, I've done a video on, I feel like I've done a video on this. If I haven't, let's just talk about it for a second. So typically the difference between a condo and a townhouse is if you own the land under the house, or you own the land the property is on. Hope that makes sense. So you either have common property where the HOA owns the land, or you have where my townhouse is here and I own everything like from the sky up to like the ground below. Like I own the place that my townhome is on. I own that land. Okay. And usually that's how you know whether it's organized as a condo community or a townhome community. And that should be in the bylaws. That should be, part of the ownership, whether it's a condo or a townhome. And so you want to make sure that you are requesting before you go under contract with a condo or a townhome. You want to make sure you're getting a couple of things. You want all of the HOA bylaws, the covenants. If you can get the minutes from the last meeting, you want to see some of their financials, because what happens sometimes in some areas, condos, it seems like a good deal until you see that monthly assessment. And sometimes they'll have special assessments. Like, let's do the condo, for example. Say the mortgage or the price of the condo is $200,000, and the HOA fee or the association fee every month is $300. Okay, so you know that the mortgage is going to be this amount, the HOA association fee is going to be $300 a month, but you don't know that they've been arguing, right, about some, things that they want to do to improve the community. Maybe they want to redo the pool or the tennis courts, or maybe the elevator is broke and they need to assess everybody a certain amount to get those things done. So you might find that you bought this condo that you thought was affordable, $200 a month, $300, association, but they're like, oh, everybody's going to be assessed a $10,000 special assessment so we can fix the elevator. So we do that. So sometimes you'll be able to see those things being discussed in the minutes of the HOA meetings. And in most states, you should be getting like a report to say, are there any special assessments planned, that sort of thing. But you want to get all of that information up front as much as possible. I have a video called like Condo Owners Beware, and you want to just watch that. So I would say if it was a choice for me specifically, condo or townhome, I would probably do townhome because you have a little bit more control of your property. But I know a lot of areas, condos are more common, like say Florida, places like that. So just know what you're getting into, because you could have some expenses you weren't expecting, because a lot of people buy condos for the ease of maintenance and sometimes just for the affordability, that sometimes they're less expensive than single family homes, depending on your area. But then you're surprised by some of those special assessments. And also, if it is hard for you to get a FHA loan on that condo or townhome, then I probably wouldn't get it either, because that means FHA, in order for condos and townhomes sometimes to keep their FHA eligibility, they have to turn in their financials. They can't have so many renters, that sort of thing. So if they're not FHA eligible, you may not want to be bothered with them either. It's like a red flag, kind of. All right. Thank you, Yvette, for that question. All right. We're at 3:05. Go ahead and hit the like button, the like and subscribe. If you're not subscribed to me now, I'm Shahida Hill, getting you over the hill to home ownership so you can confidently buy your first home. All right. The question is, if purchasing a home during the holiday season, how much less than asking price should you offer the seller? It really depends. You really want to work with your agent. And I said, I think in my last video, maybe my last live, that between Halloween and New Year's Day, you can have a lot of, you have more motivated sellers, because a lot of people just want to take their homes. If they haven't sold their home by around Thanksgiving, they want to take their home off the market. They want to get through the holidays and relist it usually in the new year. So if people are keeping their homes on the market during this time and they're on the market longer than average. So say the average days on the market in your area are 30 days, but you find a house that's been on the market for like 75 days, then that's somebody that hasn't had a sale. They probably, are waiting to sell. They're still on the market. They haven't taken it off. So you have some opportunity usually there. And some clues to that. Most of the time your agent will email or call that agent and say, hey, how flexible are your sellers? Are they willing to take less than the offer price? And a lot of times they might tell you exactly, but they'll hint to you, hey, they're really motivated. Hey, make an offer. They'll say things like that. And those are some clues that you can come in, lower, and then come in to see what other things they're selling for, come in significantly lower. They always can counter you back. I'm not saying significantly lower. don't necessarily insult them, but you can come in with something lower that you still think is reasonable that they'll accept. And you'll know whether or not, either they're going to counter you, they're going to say yes. But usually you can kind of tell by the follow up of the agent, what they're saying when they talk to your agent as to how motivated those sellers are. All right, good question. All right, Bran, how are you? I have a blue tape walk through tomorrow on new construction. I'm under contract on. What should I be looking out for? The house is fully built and the builder agrees to fix whatever is needed. All right, so for my new construction people, a blue tape walk is, the tape that when you're painting, you might put on your walls to make sure like the tape doesn't bleed. So with new construction, you do like a walkthrough before you close. You'll do a walkthrough with the builder and you'll like put on walls, anything that is not aesthetically pleasing, because sometimes they don't paint. They might have smudges on the paint. They may have, different drywall, little holes, things like that. So they'll mark it with the blue tape. So that's what's meant by a blue tape walk. So hopefully, Bran, you've gotten a home inspection on this new construction house prior to this blue tape walk. But if you haven't, well, let me say this. If it's not too late, try to add on your own private home inspection, even on new construction, because there are things that you're not going to be able to know necessarily that a home inspector may be able to find that you're not going to be able to see, right? So when they say that they're going to fix whatever is needed, they'll probably only fix the things that you bring out to them or you bring up to them. So it's really important that you take your time and look at what a home inspector would typically look at. So, and that's probably, if you still have time to get my masterclass and I'll give you some home inspections, but you can probably Google it too, like things that home inspectors look for in new construction. And those are the things you want to be a little bit more, you want to be slower. And you want to, because normally if you have the home inspection already, then the home inspector is going to tell the builder, or you'll have that report and you'll go over that with the builder. But you want to take a little bit slower. You want to make sure that you are, flushing toilets, running water, going through cycles of different things, because you're thinking everything is new, but sometimes things aren't, installed properly and that sort of thing. And typically you have a 1-year warranty on most new construction, but they have to come back into that house and take your time because things are not working. And usually they don't have to compensate you. So say there's something major wrong with it, that you move in and the heat is not working or something, the air is not working, something major is wrong with it, then they have to come in a couple of times and do some things, and you work from home. They don't have to compensate you for coming back in, doing that work, that sort of thing. So you really want to come into a situation where everything's working well and you don't really need to call them back for anything. So I have multiple home inspection videos on my channel, at least 2 or 3. I would watch some of those and just make sure that you're kind of going slowly through the process, and just don't look at cosmetic stuff. Look at some of the things that, some of the functional things as well, just to make sure they're all, how they're supposed to be. And if you did any upgrades, that sort of thing, make sure that stuff is there too. So yeah, that's what I would do. But if you're getting this for everybody, not just for Brand, but if you're getting new construction, a new construction home, you still need to do a home inspection, regardless of the warranty that they're giving you. You want somebody else looking at that house that's an expert in what it should look like and how it should be built. You don't know how many people sue their builder and they had these walkthroughs, they had all this stuff, but a lot of them didn't do home inspections ahead of time because they figured it's new, everything's new, right? So still do one just in case. Good question. All righty. Deborah, 69 years old, widow, veteran, homeless, but in 2025, I move into my new VA construction loan home. Congratulations, Deborah. So really excited for you. I'm sorry for your loss. Thank you for your service or your husband's service. And I'm really excited for you. Congratulations. Congratulations, Deborah. All right, Keisha. Is there a way to estimate closing costs in my city or county? Definitely. So, number one, I have a whole playlist, right? I have a whole playlist on mortgage lending or mortgages and that sort of thing. And some of those we talk about loan estimates. So I always say this, like, I should just do a whole thing on Shahida rules, but one of my rules is that you get your loan estimate at time of pre-approval. Like, oh, I'm approved for 500,000. Next thing you ask the lender is, I need a loan estimate. I'm thinking about moving to blah, blah, blah city. I need a loan estimate for that. And you're telling them the city or the zip code so you can get an accurate or a close to accurate amount for those taxes, because they have their, it's AI nowadays, right? They got so much data and that sort of thing. So they know by zip code what the approximate taxes are going to be for that house. A lot of times for resales, they're looking at past data. And then for new construction, they should be looking at, and I did a whole video on why new construction is usually wrong. They should be looking at like the value of the home, the millage rate, that sort of thing, to estimate what your taxes are going to be on that property. But absolutely yes. And you don't have to wait until you're under contract. You want to go ahead and get your loan estimate at time of pre-approval. And if your lender is being lazy and telling you they won't give you one, then you need to find another lender. Like, almost you need to say, I need, because this is what happens with first time home buyers. I'm pre-approved for 300,000. Oh yeah, I know. I think my mortgage is going to be $2,100. I don't know. And you have no estimate, like you're guessing. Or a lot of times you think what your mortgage payment is going to be is much lower than what it actually is. By the time you get your estimated taxes, your estimated insurance, what you thought was $2,100 is really $2,600. And sometimes people get to the point where they're under contract and they get this bigger loan estimate than what they anticipated. You want a full loan estimate. In my masterclass, I have multiple loan estimates. I have a VA loan estimate. I have an FHA loan estimate. I have a conventional loan estimate. So you can kind of see what you should be asking and what you should be requesting from your lender. But great question. Great question. Thank you. All right. Soldier Risk is back to piggyback on question about deed. If a quit claim deed is granted, will the bank allow the new owner to take over payments? Let's go over this again. Just because they're on the deed does not put them on the loan. And maybe I wasn't clear, so I do apologize. Let me go back. Let's do my dad's situation. My husband and I are on the mortgage. If I add my dad, we're on the mortgage and the deed. If I add my dad to my deed, I could quit claim him to my deed. He has nothing to do with my mortgage, but he's an owner of the house. He's an owner, the same type of owner. He's the exact same value ownership of my property as I am and as my husband is. However, he has no liability. And that's and I probably didn't say this right with the first question. And that's why it's a big deal, because you're on the hook. Whoever has the mortgage in their name, you're on the hook for that payment, but you're not there. They are not on the hook. Wherever you add to your deed after that mortgage is closed, they don't have to pay a dime of your mortgage. They don't have to contribute to that payment, but they still are an owner of that house. Let me say that again. They own your house, and you have to ask them. They can never pay you a dime. And you have to ask them or get their permission or get their approval if you want to sell or refinance that house. So in this question, it says, will the bank allow the new owner to take over payments? No, because they are under agreement with you, right? They're under agreement with you because you originally you've originally taken out the mortgage. They don't even know if this other person would be approved for the mortgage. So let's talk about a divorce situation. You're both on, say you're both on the deed and the mortgage. Then usually in a divorce situation, if one person wants to stay in the house, the spouse that wants to stay has to refinance that house, right? And get the other person out, like get their own loan to pay the house, to buy the house, and either buy the other person off or just, pay off the house, whatever it is. But the only way you're adding somebody to your mortgage is if they probably refinance the mortgage and you add them in. But they have no liability on the mortgage. You can add 20 people to your deed and they don't have any liability on your mortgage. You can't add people to your mortgage unless you're doing like a refinance kind of situation. All right, good question. Nikki 4010. Hey, Nikki, I have 100% in-house financing at 7%. Is that too high? With a $7,500 grant for closing. Also, my credit was pulled without my permission hard, and it dropped my credit 20 points. Am I stuck with them? When you say in-house financing, I'm assuming it's still at a bank, right? Not like the seller's financing, I guess. So 100% financing is not bad necessarily, but it's going to be higher. The interest rate is going to be higher with 100% financing. That's one of the things you're giving up for the 100% financing. Your interest rate is going to be higher. So that's not unusual. So right now, I think the interest rate was at 7%, and that's what people are putting down money. So it doesn't appear that that's too crazy. 100% financing, this is for everybody. If you're usually doing 100% financing, that interest rate will be a little bit higher than the average interest rate. Say if you were putting money down, okay? That's what you want to compare it to. They're giving you a $7,500 grant for closing. Also, my credit was pulled without my permission. Let me say this. It's very hard to prove without your permission, because you put or you either gave somebody your social security number at some point. Either you gave it to them over the phone or you put it on an application. And if you're giving somebody your social security number, the implication typically, especially a lender, is that they're going to pull your credit. The only reason they need your social security number is for them to pull your credit. Now, I'm shocked. It's not typical that even hard credit pull, that one hard credit pull will drop your credit score 20 points. Now, it could be your Vantage score that maybe you're looking at Credit Karma or something else that you're seeing that 20-point drop, but your FICO score will not drop 20 points with one hard credit pull. It's usually 1 to 5 points at the most. So I would ask them and they typically will give you this as part of the mortgage process, a printout of your credit scores per credit bureau. And if they did it, I'm assuming, well, I don't know if they did it twice, but at some point you probably gave them permission. Maybe you didn't realize you gave them permission, but at some point you probably gave them permission to pull your credit. So I'm not saying it's bad, but I also say you should get 3 quotes, right? And for everybody that maybe you're new to my channel, that there is a rule for rate shopping. You can shop as much as you want, and it's only going to be one for mortgages, the same kind of loan for mortgages, and it's only one credit pull. So you could have gotten, at the same time that you did this one credit pull, you could have quoted with other lenders. So I would say at this point, if you're not thinking you're maybe getting the best deal, quote with another lender. If you only can do 100% financing, quote with another, like Navy Federal, for example, quote with them. They have 100% financing product, and get 2 loan estimates and see which one would make the most sense for you. But like what you get in the grant, you're getting 100% financing. You want to compare apples to apples, because Navy Federal may not be giving you a grant, right? So, or, is the seller contributing to your closing costs? Do you have a contract in place? I don't know what part of this you're in, but I don't think it's too crazy. But you should always, to avoid somebody, or you feeling that somebody's taking advantage of you, that's why you get multiple quotes. You don't just go in with one person and be like, I don't know if I'm getting a good deal. But if you had 3 in front of you, you can say, oh, this one's better than this one. You could really compare those. You can compare, like, are they charging you points? Are they charging you, is their interest rate too much? Like, you can really look at, everything side by side. Good question. If you're not under contract, it's probably a good idea to get my masterclass. The link is in the description. All righty. Zillow wrote an article saying Atlanta's in a buyer's market. Do you believe this is true? I would say we're in a balanced market. It really depends on what you're trying to buy in Atlanta right now. But I would say it's more in a balanced market, because some things are still selling pretty quickly, where you'll see them only on the market for 3-4 days, but you are seeing more things stay on the market longer and longer. I believe once you're over 3 months of inventory, typically you're getting into a balance to buyer's market. And in a lot of areas we are there. Plus it's a time of year as well. So I'm going to say I agree with it, but it really depends. Like, if you have like a great affordable move-in ready house, it's probably still going to go pretty quick. All right, good question. Muva, love watching your video. You're super intelligent. Thank you. I appreciate it. All right, while we have a little break, We're at 3:59. It's a good live, you guys. Y'all had, what's on TV tonight? Maybe who's playing? Like, I know there's a football game, but maybe it didn't start yet. So y'all are here. So I appreciate it. But please, while you have a moment, please hit like and subscribe. That helps with the algorithm and all of that. I will be live again. So if you don't get your question answered tonight, I'll be live again on next Thursday. And that leads us into Thanksgiving. Then I won't go live again until December. All right. Any other questions? All right. Okay. Let me say this. So he says a quit claim deed removes the original owner. You could do a quit claim deed to remove somebody, like, remove yourself and possibly remove yourself and add somebody else. However, that doesn't take them off the loan, or that doesn't put them on the loan. You're still with the loan. That makes sense. So you could, depending on how the quick claim deed is added, like you could add somebody to it. You could take yourself off. There's different ways you can do the deed, but that doesn't put them on the mortgage. So you could say that I want to, totally give my house to my dad. Like, I'm quit claiming my house to you, Dad, right? And I want to take, I'm still on the mortgage. He's not on the mortgage. So you're still like, that's probably not a good idea, right? Unless the house is paid for, you don't have any issues. And I would just say that's probably not a good idea. Don't think that when you're quit claiming the house to that person, that you're also adding them to the mortgage. So if you have a mortgage on a house, there's very little reason to quit claim the entire house over to them. Okay. And so, like, maybe make it really clearly. So if you're quit claiming, like you're taking your deed and giving it to somebody else, and you have a mortgage, you're still responsible for that mortgage, even though they own your house. So they own your house 100% in the example you're saying, where you're on the mortgage now. And I think I was talking to different things. Like, you can add, talked about adding somebody to your deed. You can add somebody to your deed without their permission, that sort of thing. You can quit claim somebody to your deed without them signing. You can do all of those. Let me try to think. You can add somebody to your deed. You also can quit claim your ownership over to somebody else, but you do have to, that has nothing to do with the mortgage. Let me say that has nothing to do with the mortgage. All right. Faith is powerful. I'm very undecided. This is going to be my second home. Lender, sorry, I'm very undecided. This is going to be my second home. Lender is telling me I need between 5 and 20% down payment. How true is this? And this time I'm buying the second home alone without my husband. It really depends on why they're telling you this. Are you keeping the first house? That's the first question. So if you are keeping the first house, then this could be considered either a second property or a investment property. It really depends on why they're telling you between 5 and 20%, because a lot of times the lower down payment amounts are reserved for owner occupancy, and you can't owner occupy two things at the same time, typically. Now, there are some workarounds. Maybe if you rent out the first property and you're moving like out of state or something like that, the lender can work that out for that to be an owner occupied property. But if you are trying to keep both and they're in pretty close proximity, that could be an issue. So it really depends. Like I said to the other viewer on the chat, the best way for you to know if you're being taken advantage of or if somebody's not telling you the truth is to get another quote. And you don't even have to necessarily, when you're getting the second quote, you don't necessarily have to have them pull your credit and do a whole application. All you have to do to the second person is say, hey, this is the situation. I already got pre-approved with, blah, blah, blah lender. They're telling me that I need to put 5 to 20% down. I have this house. This is how much it's worth, blah, 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 blah. And another lender can tell you pretty easily whether that's going to be the same with them or if that's not the case, right? But if you're trying to keep both, then sometimes you will have to pay definitely a higher down payment because you're not owner occupying that property. The things like FHA, conventional that you're owner occupying, USDA, all of those loans are put in place to incentivize home ownership. They're not to help investors. So that's why when you start getting like multiple properties, then that second, third property is going to have a higher down payment, 10%, 20%, because it is considered an investment. It's not considered your primary residence. So that could be why they're quoting you those higher down payments. But you could use, if you're keeping the first house, you could use the equity from the first house to pay that down payment, and they can give you that option as well. Thank you. Rashid, hey, like Shahida. Is refinancing a newly mortgaged home within a year a given? No, not at all. I mean, it really depends. So a lot of people don't, it doesn't make sense. I did a video about this. So it's called When It Makes Sense to Refinance, the 6 times it makes sense to refinance. So you don't just refinance your home every year. Refinancing is not free typically. Now, some of these lenders are offering, depending on what lender you're going with, like if you refinance within a certain amount of time, they might do it for free. I'm not sure your situation, but it only makes sense to refinance your mortgage if you're saving at least 1% typically. Okay, so you have to know, okay, if you are closing today at 6.5%, for example, and interest rates at the end of this year are 6%, you're not going to refinance to save a half of a percent. It doesn't make financial sense because in order after you pay your closing costs and all of those things, you have a break even. You may not break even with your savings till several years down the line. So no, it's not a given. That's like the answer to the main answer to that question is no, it's not a given. You only refinance when it makes sense to refinance financially. And generally speaking, that's when you're saving at least 1% on your interest rate. Thank you for the question. All right. Are there any more questions? All right. Have been going through the process with NACA. Super frustrating. All right. So, if those of you don't know what NACA is, a mortgage program that allows you to buy a house with no down payment, no closing costs, typically a lower interest rate, no mortgage insurance, but it is, again, a program that you have to go through. So, he's saying, I have been going through the process with NACA. Super frustrating. Trying to buy new construction. No one will communicate. Builder says go with FHA. Thoughts? All right. So I like NACA with new construction over resales typically because it's usually easier because you can be under contract on that home longer. So some of those things can get worked out. So you can definitely do NACA on new construction. But I guess what the builder's probably saying is, hey, like, don't wait on NACA because you have to wait for your approval and that sort of thing. Just go ahead and use FHA. So you're going to have to, number one, hopefully you're part of some of these NACA Facebook groups for your state. So I would definitely, if you're not already, I want you to join a NACA Facebook group for your state and see what people are saying in that group about like the time turnarounds, that sort of thing. Because when you come to NACA organized, very organized, and you have some money saved already, then the process is not that long. But if you like, NACA has like a whole counseling process. So if they feel like you don't have enough money saved, they may say, hey, we want you to save money for 6 months before we can approve you. Or if you have some credit, things, even though there's no credit score with NACA, if they see certain things on your credit, they may have you clean those things up ahead of time. And then sometimes the counselors quit, where say you're working with a counselor for a few months and then that counselor quits their job or leaves that job. Sometimes you're starting all over with somebody new. Those are all the things that I've heard people go through with NACA. So you're going to have to see whether or not it's going to be worth it for you to kind of stick it out with NACA or just do the easy route with FHA. So if the builder, figure out what the builder incentives are. if you were to go with them, are they offering the lower interest rate? Are they offering closing costs? Like, what are they offering? And do that, quote or estimate versus if you did a NACA loan, and how much like savings would you accumulate? So say the savings is like $100. I don't know. It might not be as much. It might not be worth it to wait for NACA, but say the savings is like $500. It may be worth it for you to wait for NACA, but you have to, like you said, some people, they give up on NACA after a little while. Some people push it through, and it's really it makes it worth it on the other side. So join the NACA Facebook groups, even, see people talking, see what their success, see their average turnarounds, that sort of thing. You're going to have to make a decision for yourself. Is the NACA benefits worth the hassle for you? Or should you just go with some of the incentives that the builder's offering and don't worry about NACA? Good question. All right, we're at 7:54, so we are winding down. We're at 3:59, so I think I'm going to take my last 5 questions. Thank you guys so much. I feel like I didn't explain the quick claim deed thing appropriately, so hopefully I'm gonna put some links after this live to like how quick claiming your house works. But I do want to say, definitely remember that the deed is separate from your mortgage. Just because you add somebody to your deed or quick claim your deed over to somebody else does not mean they have any liability for your mortgage. You will be 100%. And some people do this, and they either quick claim the deed or they add somebody to their mortgage, and they add somebody to their deed, or they quick claim their deed over to somebody else that still has a mortgage. Remember, usually the lender is not aware of all of this things going on with your deed usually, but the mortgage, you sign that you are going to pay that mortgage. And so if you feel like you're doing this because you don't have enough money, that sort of thing, I'd rather just sell your house probably, or, do something else, try to work out something with the lender versus trying to give somebody, ownership with no liability. That's what it really is. It's ownership with no liability. It's not going to impact their credit if you don't pay or if you miss a payment. It's only going to impact you. All right, good question. How is a month? This is the first of the 5. How is the amount of months of inventory determined? So the way they do it is, if no other homes were listed, how long would it take for those homes to sell? So if they just did a snapshot of like your city, they would say, hey, for the 300 homes listed, and on average, they're closing 80 homes a month or something like that. Or say, let me get easy. So they have 300 homes listed, and on average, they're closing 100 homes a month. It would take 3 months for them to get rid of all of their inventory. So that's how they pretty much do the math. It's the amount of homes for sale versus how long, if no other homes were listed, how long it would take those homes to get off the market. And the longer that time is, the more it's considered a seller's market, because you have more inventory than you have buyers, and that balance is off. A buyer's market, there's more inventory than there are buyers. So you have a lot of sellers and you don't have a lot of buyers. So, these buyers have the upper hand, because if you don't take their offer, somebody else will take their offer. Where it was the exact opposite during the pandemic. There were all of these buyers and only a little bit of inventory. That's why prices went up. People were paying, no closing costs, all of those things, because there were so many buyers and so little inventory. That's what makes a seller's market. All right, good question. We'll have 4 more. Kendra, what should I know as a first-time home buyer for a newly built home? I mean, your main things, Kendra, are, and I'm gonna talk about my masterclass. I do have a new construction portion of my masterclass. You want to know, I would say to be on the safe side with new construction, number 1, get 1 quote outside of the preferred lender. So you want to know that by law, you don't have to use their preferred lender. And a lot of people don't know that. Like, no builder can say you have to use this lender to buy this house. The only thing they can do by law is incentivize you to use their lender. And usually those incentives are significant. It could be that they're going to buy down your rate. It could be that they're going to pay your closing costs, those types of things. So they put some significant incentives on new construction so that you would be more likely to use their lender. But get at least one outside quote so you know if those incentives are being made up maybe with a higher interest rate or something like that. So I always tell people to get at least one outside quote. I also want you to definitely always, I talked to the other gentleman about this, get a home inspection. Just because it is new construction doesn't mean that you don't need a home inspection. So still get a home inspection. If you want to be really diligent, get two. Get one at the pre-drywall before the walls go up so they can look at all of the framing and that sort of thing. And then get one at the final. Some people just get the final. That's better than nothing. So definitely do that. What else I want to say? And then you want to also know before you move in, because I think a lot of things are like, oh, this is so nice. This is so, really research the neighborhoods, because the home may be good, but you don't like the schools, or somebody was buying new construction. They're like, I didn't know that they were building a liquor store in the back of the house. Like, so you want to do, or back of the subdivision, you want to do some research ahead of time, because a lot of times when you're looking at new construction, they bought some land somewhere, they're starting fresh, in a lot of these suburb areas, and you may not necessarily have done your research as to what's coming, what else is coming in that area. So spend some time and do that kind of research, just to make sure that you're getting a good deal. Because a lot of times they're building things fast, they're building them cheaper than they used to build them. So you just want to make sure you're doing all of your due diligence with new construction and not being so like, oh, it's new, it's perfect, because typically it's not new. It's new, but it's not perfect. So those are my three suggestions. Also get my masterclass. All right, sold out. Question: not quite ready to purchase a home yet due to debt. Should we get underwritten for a mortgage to see how we should attack the debt? No, I don't think necessarily. So if you feel, I like people to get pre-approved to kind of know where they stand. That's usually more for credit, what you'll get approved for, but you can just I have a video on my channel called Can I Afford a House? And you will kind of get a good idea by just using a debt to income ratio calculator to know pretty much how much you would get approved for. And you would know like how much debt I have to pay down in order for us to afford a house, or, if for you to get, you said we, so you kind of would have an idea. And the way it works, so say I'm going to use $1,000. Say that you make $1,000 a month. And that's all you make. The most a mortgage lender typically wants to see is around 45% of your income in debt. So say that your debt is 40%. Say of that $1,000 a month that you make, $400 is like your car payment, it's your student loans, all of that. That means you only have 5% left that they would lend you for a house. They don't care about that 55 because they know that's food, that's other income, that's other things, but they don't want to see, including your mortgage. They don't want to see typically a 45%, maybe 49%. If your credit is excellent, they'll go a little bit higher, but that's what you're looking at. And what happens, the reason why people don't get approved for as much as they want to get approved for is typically because that debt to income ratio, that debt amount is too high. So even though you might be making good money, your debt to income ratio doesn't leave a lot of room for a mortgage. So you can use a debt to income calculator to kind of get an idea of what they would approve you for, but only put your debt. Your Netflix subscription is not debt. Your utilities is not debt. Anytime you've borrowed money, and you don't even have to put your rent in there because you're not going to be renting and have your house, but you can know how much money is left over that they'll probably lend you for your mortgage. Good question. Are mobile homes a bad investment? Usually, I'm saying just usually, because usually they go down in value, as opposed to going up in value like traditional real estate. So a mobile home, moves for the most part unless you have it affixed to the land permanently. And that's how, so if you don't have the mobile home affixed to a property permanent, like you put it on a permanent foundation, then it's actually not even real estate. It's more like a car, because, and they'll give it a VIN number instead of a deed. So that's a big difference. So, but if you're buying one or you plan on affixing the property to the land, then you will get a deed for that house, because now they can tax it. If it's something that you can pick up and move, it's hard to tax something that you can move all the time. So as far as property taxes go, but they do give it a VIN number so they can, apply like car taxes to it in most areas. But I would say for the most part, you do a mobile home for affordability than you do for like investing. Like, oh, I think if I buy this mobile home at $100,000 now, that is going to be worth $200,000 in a couple of years. That's typically not the case unless the land and the property around you, like there's some mobile home in California, because they're on like really good land, it has appreciated in value, but it's not the property necessarily itself, it's where it's sitting. So you might luck up and the land that you buy and you put the home on really goes up in value over time. But in general, I would say they're an investment that does not appreciate as quickly as traditional real estate. And so you just want to be mindful of that when you're making that investment. It could just be that you want more affordability so you can save money and take your savings because you didn't buy a traditional home, you're saving maybe a significant amount per month, and you're taking that savings and you're investing that savings elsewhere. But I would say, again, in general, you could look up mobile homes in your area, your town, that sort of thing, and see what they're valued at and see what people bought them for. And that'll give you a good idea of how quickly they're appreciating in your area or in the area you're thinking about moving to. All right. Thank you. Already answered that question. I'm not going to take it again. We have to go back, but it was about using your 401k for, so I'll take one more question. It was about using your 401k or your retirement accounts for your down payment. All right. Thank you. Thank you. Thank you. All right. All right. I think that's it. All right. Thank you guys for tonight. I really appreciate you. Hit the like and subscribe on your way out, and I'll see you next Thursday. Bye. And look for that information about the quick claim deeds in the description, just in case I got a little bit confused as to what she was asking. All right. Thank you guys. Have a good night.